Dear students and scholars, let us begin ASC 321 with a practical mindset. This is a small topic, but it can create a very visible earnings impact. Accounting Standards Codification Topic 321 under US GAAP governs how entities measure and report investments in equity securities. The big contrast from ASC 320 is this. Debt securities had categories like held to maturity, trading, and available for sale, but equity securities under ASC 321 generally send fair value changes directly to net income. In this video, we will confirm scope, check whether fair value is readily determinable, apply the earnings based measurement model, understand the measurement alternative, and keep the ASC 323, ASC 820, IFRS, and SAP boundaries clear. Practice questions are reserved for the next video, so here we are building the concept foundation carefully. We start with scope because ASC 321 does not automatically apply to every ownership interest. Usually, equity securities held by non specialized entities can fall inside the topic. Ownership interests in partnerships, unincorporated joint ventures, and limited liability companies can also be treated as equity securities for this purpose. Certain forwards and purchased options may also be in scope when they are not treated as derivatives under ASC 815. But several items are outside ASC 321. Derivatives go to ASC 815. Equity method investments go to ASC 323. Consolidated subsidiaries go to ASC 810. Federal Home Loan Bank stock, Federal Reserve Bank stock, and specialized fair value industries also have separate treatment. The first lesson is simple. Do not see an ownership interest and immediately shout ASC 321. Accounting likes enthusiasm, but it likes scope analysis even more. Once scope is confirmed, use the ASC 321 decision map. First, ask whether the equity security has a readily determinable fair value. If yes, the dominant model applies, fair value through earnings. If no, check whether the ASC 820 net asset value practical expedient is available. Net asset value or NAV may be used only when the ASC 820 eligibility criteria are satisfied. If NAV does not apply, the entity may consider the ASC 321 measurement alternative. This path matters because the measurement alternative is not the default shortcut for every private investment. ASC 321 is mainly an earnings model, not an OCI model. Fair value changes generally flow to net income, not to other comprehensive income. When an equity security has a readily determinable fair value, the default rule is fair value through earnings. The security is measured at fair value on the statement of financial position at each reporting date using ASC 820 fair value guidance. Unrealized holding gains are recognized in net income. Unrealized holding losses are also recognized in net income. This is different from available for sale debt securities under ASC 320, where unrealized holding changes generally go to OCI and AOCI. Do not apply the debt security buckets such as trading, available for sale, and held to maturity to ASC 321 equity securities. Equity securities have no contractual maturity date, so fair value becomes central. In simple terms, ASC 321 does not give equity fair value changes a quiet room in OCI. Now let us apply the fair value through earnings model with a 2026 example. On January 1st, 2026, an entity purchases an equity security for $100,000. At December 31st, 2026, the fair value is $118,000 and the security has readily determinable fair value. Tax effects are ignored for teaching clarity. The unrealized gain is 118,000 minus 100,000, which equals $18,000. The journal entry is debit equity securities investment $18,000 and credit unrealized gain in earnings $18,000. The balance sheet carrying amount moves from 100,000 to 118,000. The earnings effect is $18,000. No OCI entry, no AOCI account, and no deferred recognition. The number reconciles cleanly. This slide gives us one of the most important ASC 321 memory points. No equity OCI parking under US GAAP for the standard ASC 321 model. Under ASC 320, available for sale debt securities generally send unrealized changes to other comprehensive income, and the cumulative amount sits in accumulated other comprehensive income. Under ASC 321, equity securities generally send unrealized changes to net income each reporting period. There is no OCI deferral mechanism, no AOCI balance, and no later recycling event for those standard equity fair value changes. Same word, investment, but completely different accounting model. If investments had traffic lanes, ASC 320 AFS debt would take the OCI lane, while ASC 321 equity usually drives straight into earnings. What happens when an equity security does not have readily determinable fair value? ASC 321 does not require management to guess fair value every period without evidence. Instead, the entity follows a structured measurement choice. First, check whether the ASC 820 NAV practical expedient applies. This is generally relevant when the investee is an investment company or a similar entities whose interests are redeemable at NAV, and ASC 820 eligibility must be confirmed. If eligible, apply the NAV practical expedient. If not eligible, the entity may elect the ASC 321 measurement alternative investment by investment. That election uses initial cost as the starting point, then adjusts for impairment and observable price changes. The key professional habit is documentation. The choice and evidence must be supportable. The ASC 321 measurement alternative can be remembered as a carrying amount bridge. Start with initial cost. Subtract impairment when qualitative indicators exist and estimated fair value is below carrying amount. Then add or subtract observable price changes from orderly transactions involving identical or similar investments of the same issuer. The result is the adjusted carrying amount. Observable price changes must come from orderly transactions, not forced liquidations. They must involve the same issuer and an identical or similar investment. The mini example on the slide is simple. Initial cost is $200,000. Observable adjusted value is $230,000. So the increase recognized in earnings is $30,000. Again, the change goes to earnings. The measurement alternative is not an OCI vacation package. Observable price changes require judgment. The entity must make a reasonable effort to identify reasonably knowable observable price changes as of the measurement date. Same issuer means the transaction must involve the legal entity that issued the security being measured. Different subsidiaries or affiliates do not automatically qualify. Identical investment is straightforward, but similar investment requires analysis. An orderly transaction means normal market exposure, not a forced sale, distress sale, or liquidation sale. The entity must also consider differences in voting rights, distribution rights, liquidation preferences, seniority, and conversion features. If rights and obligations differ materially, the observed price may require adjustment or it may not be appropriate at all. This is where accounting becomes less like pressing a button and more like careful professional judgment. For equity securities measured under the ASC 321 measurement alternative, impairment uses a simplified one step model. First, assess qualitative indicators each period. These may include significant financial difficulty of the issuer, adverse changes in business conditions, or deteriorating operating results. Second, if impairment indicators exist, estimate fair value using ASC 820 guidance. Third, calculate the impairment loss as carrying amount minus estimated fair value. Fourth, recognize the loss in net income and reduce the carrying amount to the new estimated fair value. In the example, the carrying amount is $150,000, estimated fair value is $110,000, and the impairment loss is $40,000. The entry is debit impairment loss $40,000 and credit equity securities investment $40,000. After the entry, the new carrying amount is $110,000. ASC 321 is not ASC 323. That boundary matters. Equity securities without significant influence may fall under ASC 321 and use fair value through earnings or the measurement alternative. Equity method investments with significant influence generally follow ASC 323, where the investor picks up its share of investee income or loss. Consolidated subsidiaries follow ASC 810, where full consolidation replaces separate investment accounting. If the equity method stops because significant influence is lost, the carrying value at that date becomes the retained investment basis, and subsequent measurement follows ASC 321. Observable price changes at transition may require remeasurement. So do not assume every equity ownership interest is ASC 321. Percentage ownership helps, but influence and control decide the real boundary. Sales and dividends continue the earnings focused model. Because ASC 321 equity securities with readily determinable fair value are already carried at fair value with changes in earnings, the gain or loss at sale is usually limited to movement since the last measurement date. There is no large OCI recycling event like we saw with AFS debt securities. If the carrying amount at sale is $118,000 and the sale proceeds are $121,000, the gain recognized in earnings is $3,000. For dividends, the entry is also straightforward: debit cash or dividend receivable and credit dividend income. Dividend income flows through earnings whether the equity security is measured at fair value or under the measurement alternative. Do not reduce the carrying amount for normal dividends under ASC 321 the way equity method accounting may require under ASC 323. Now let us compare frameworks compactly. Under US GAAP ASC 321, fair value changes for equity securities generally go to net earnings each period, and there is generally no OCI election for ordinary ASC 321 equity securities. Under IFRS 9, fair value through profit or loss, or FVTPL, is the general model for equity investments, but an irrevocable fair value through other comprehensive income, or FVOCI, election may be available for certain non trading equity instruments. Gains and losses under that FVOCI election do not recycle to profit or loss on sale. Under statutory accounting principles, or SAP, the treatment follows NAIC statutory guidance, including SSAP number 30 and SSAP number 97 where applicable. The same word fair value can lead to different destinations, so compare the framework objective before comparing the label. Let us close with the ASC 321 checklist. First, confirm the instrument is an equity security and the entity is not a specialized fair value industry. Second, exclude derivatives, equity method investments, and consolidated subsidiaries by applying ASC 815, ASC 323, or ASC 810 where needed. Third, if readily determinable fair value exists, Use fair value through earnings with both unrealized gains and losses in net income. Fourth, if readily determinable fair value does not exist, check the ASC 820 NAV practical expedient. Fifth, use the ASC 321 measurement alternative only when allowed, investment by investment, with reassessment each reporting period. Sixth, recognize impairment losses in net income. Seventh, record dividends in income. Eighth, keep ASC 323, ASC 820, IFRS, and SAP boundaries clear. In the next video, we will practice ASC 321 with 4 MCQs, 2 short answers, and 1 practical case study. If this concept lesson helped you, please like the video, subscribe to the channel, support the course, and share it with your colleagues who are learning US GAAP. I will see you in the practice session.